guys, pretty special day today. We got a CEO and CFO of a publicly traded company on the TSX, BTB REIT. I'm thrilled to have him here. I'm here with my dad, Claude Tetrault, and I'm also here with Michel Leonard.
Mathieu Bolte.
Mathieu Bolte. Awesome. Great to have you guys here. Michel, we go way back. You and my dad go even further back.
Right.
15, 20 years, I don't know.
15 years for sure.
15 years. All right, let's talk about, BTB, stock symbol BTB-UN, Canadian publicly traded REIT. It's a Quebec-focused REIT. Before we get into the details, give us an overview again of what the REIT does, how big is it, what it owns, the debt, just some big numbers.
The big numbers or the big metrics is we own 6 million square feet of real estate that's spread out within industrial, office, and retail. The bulk of our ownership right now is in office. And what's important to note is that our office buildings are located in suburban environments. So suburban environments, due to pandemic, have fared much better than the downtowns have. So if you look at our occupancy rate within our office properties, whether in Ottawa, Quebec City, or Montreal, everything has been stable and on an upswing. So the problems that everybody are talking about regarding the occupancy of office buildings is mainly centered around the problematic of returning to the office space in the downtowns versus in the suburbs where the office buildings are located closer to where employees live, and as a result, the migration back to the office property in the suburb has been tremendous.
Okay.
However,
I'll just
nobody
stop
talks
you here
about
a sec.
it.
Okay, let's back it up a bit. 100% Quebec?
No. If you look at the way that we can talk about our geographical diversification, we own properties in Quebec City, Montreal, Ottawa, Saskatoon, and Edmonton.
What's the percentage in the province of Quebec?
54%.
Oh, okay. I thought it was bigger than that. 54?
Yep.
And what's the percentage office?
Percentage office, 48%.
Okay, so less
Total
than 50%
portfolio.
office. And the rest of that 52 is industrial and...
The rest is, we used to be 18% industrial, now we're 32% industrial.
Okay.
So there's been a reduction in office and an increase in industrial, and very stable on the retail front.
Okay.
What's interesting about our retail is 2 years ago, everybody, if you read the newspaper, people were saying, oh, dump your retail, you got to sell all your retail properties because nobody is going to shop in person anymore. Everybody's going to shop by the internet. All of a sudden, we're seeing traffic into our retail environment like skyrocketing, where sales per square foot are higher today than they were in 2019, so pre-COVID, higher sales. And we have incredible opportunities that are offered to us in our retail segment as well, in the redevelopment into residential, which is something we can talk about a little bit later if you'd like.
The penalty box of the stock, let's start there.
Yep.
So the stock's at $3.20 or 15 cents or whatever. This stock, as far as I remember it, was always kind of like a $4 stock, and it trended up to...
January 2020, it was at north of $5.50.
Yeah, I remember that. It rallied there right before COVID.
Yep.
But, okay, what's happened to the funds from operation, or the NOI, or however you want to measure it? What's happened to the net operating income of BTB REIT in the last 3 years?
Skyrocketed up.
On a per share basis?
Per share basis.
Okay, what was it 3 years ago before COVID?
We were, right now, if you look at our pure, he's going to give you the exact number, but if you look at the pure IFRS value of our portfolio, just to talk about the stock, so we're on an IFRS appraised value, we're at $5.44 per unit.
Yeah, but forget about IFRS. Let's talk about the actual NOI or the AFFO.
AFFO, we're at 72%. 4 years ago, we were at close to 120%. So it meant that we were distributing 20% more funds than we were generating then. Now we're distributing 28% funds less than what we're generating. So meaning...
Dividend is 30 cents?
Dividend is 30 cents per year.
What is the real estate generating?
Real estate is generating 42, 44 cents.
Last year, we see, if we just go back, here I have the first quarter because we just published the first quarter.
Just what is it generating? It's a pretty simple
45
question.
cents.
45 cents.
Per unit.
Okay, 45 cents per unit, you're paying out 30. You've done a lot of real estate analysis. That's a good number.
But the problem with a lot of REITs is they were overpaying. And now, that's why I'm surprised, because I remember when you were paying a considerable amount, and now it seems to be way better than it used to be, but your stock is down 60%, 70%. Now, is it because when we go on our machines to do the analysis of REITs, it shows that you mentioned your 42% office, it shows that it's 58% on Thomson Reuters, on all the other researches. So have they got it wrong?
They definitely have it wrong. It means that they haven't updated their site.
Oh, okay.
And I don't think that they go into our MD&A and get the right information on a quarterly basis. Because if on a 2-year basis we went from 18% industrial to 32% industrial, I doubt that they're tracking that.
Yeah. Indeed, do most analysts differentiate because your point about being office in the suburbs versus offices downtown?
All of a sudden, it's just like you were saying, basically the market is throwing out the baby with the bathwater as far as office is concerned. What's interesting is that we went from 54% to 48% office, but we've sold all our properties north of our IFRS value, the office. So there are still people that are buying our office properties at decent prices, and the decent price is north of IFRS value.
How do they come up with IFRS value? What do they use to you say here the stock is worth $5.44 IFRS value. It's trading at $3.15. The obvious question is, okay, there's a discount. You guys are in the penalty box. People don't like office. You're saying you sold properties north of IFRS. How is this 544 calculated?
The exercise we do, first of all, what we have in our books is on the fair market value of the assets.
And who calculates it? And what is that number based on?
So what we do on an annual basis, we're always going to look now at the top 15 properties. Then every time we refinance, every time we purchase the properties, it's always externally appraised. Okay, so that's done. So what we communicated at the end of 2022 is about 70% of our portfolio has been externally appraised, okay, by authors or firms that are specialized in that. So what we do is, with what's going on with the cap rates, we did start it in the third quarter last year. We did adjustments as well in the fourth quarter last year. The right reflection of what we see in the market. And the last 30% that is internally done usually is the smaller properties that we leverage what we did with the external appraisers in terms of assumptions, and we applied that to the rest. So we're consistent across the book. So when we talk about the 5.44, it's really the asset less liabilities divided by the number of outstanding units.
And what have you seen in the cap rates used in your properties in the last 2 years to come to this IFRS?
We did take an adjustment of around 30 basis points for retail and office, and
change of cap rate you're talking about?
Increase
from
of cap
what to
rates.
what? What was the average? From what to what?
We're close to 670 for office.
70 for suburban office.
Yeah.
Okay. So it was at 640, is that what you're saying?
Yeah.
It was at 6.4, it went to 6.7. What would you say to someone who said, that's not enough, cap rates need to go to 7?
I think we have to consider there's different factors. First, the suburban. We're not in tertiary cities or secondary cities. It's really outside of Montreal, Ottawa, and Quebec City. Second of all, I think it's highly liquid assets. So we don't have assets of higher than, let's say the assets average, the highest one is closer to 50 million. 50 million brings a larger potential buyers as well, which bigger assets will probably not be as attractive for some of the larger buyers. But in our case, there's a lot of private wealth and family office that are interested to buy those assets. So that's why when we sell, we put an asset on the market. I think our range of potential buyers is pretty large, actually. And that's why we managed to keep our values.
Do you think, okay, and the NOI, the net operating income, you said it's up significantly. Did it drop for you guys quite a bit during COVID?
The first year when we started, we had to take some additional provisions because of the subsidies that we had to incur with the government. So we were responsible for 25% of some of the rent roll of our tenants. We were more conservative as well in terms of potential collection and what would happen with COVID. But obviously at the end, what we realized is portfolio has been extremely resilient. Only out of 650 tenants, we only had 4 bankruptcies. Small restaurant, 1 retailer, 1 sport shop, and then another small one. But other than that's the exposure that we had in terms of bankruptcies.
Everyone else paid their monthly rent.
Yeah.
Okay.
We had a collection rate of 99% during COVID.
Did the rents go down or go up after?
The rents are going up. Right now, when we're negotiating a new lease with an office tenant, we're getting about, on average, 12% increase.
12% year over year.
Yeah, that's in the office segment. In the retail, it's higher, and in the industrial, we didn't have any leases coming to maturity in the industrial, so we don't have the statistics.
Well, Michel, it's mind-blowing that you're getting 12% more in office when everybody around here is getting 12% less, round number, here in downtown Winnipeg. So why are you getting 12% more?
Because we're located in the suburbs, and you're seeing in the downtown where companies are reducing their footprint, we're not seeing this in the suburbs. On the contrary, in the suburbs, we're seeing an increase in the footprint. We had recently in Laval, we had M&P, an accounting firm that took over Deloitte, bought the secondary offices of Deloitte, and they just taken 8,000 square feet more. We have them in another location, they're looking for 6,000 square feet more. So we're seeing that professional offices are increasing their footprint in the suburbs. We're seeing the KPMGs of this world, accounting firms, that are located, that generally, principally, were located in the downtown environment. Investment firm as well. And all of a sudden, they're decentralizing. So what was centralized before, they're decentralizing because they want the employees to be back at work. They want to cater to the employees, and they want to make sure that they're going to locate their operation in close proximity. So that's what we're seeing in our markets. And it's the same. I make this comparison, and I don't know how strong it is, but it's 2 years ago when I said earlier that people were saying, the critics were saying, sell all your retail. Then all of a sudden the retailers are doing well again and so on when we have development opportunities that we can talk about with the retail segment. I think we're right now at the same spot in office space where people are saying, sell your office buildings, that's worth nothing, to in 2 years' time, people are going to be back in the office. I think that come September, there's going to be a big difference. You're going to see employers that are going to be stricter about coming back to the office. Right now, we're not seeing it. It's the summer. People are saying, yeah, I'm going to enjoy the summer. I'm going on the holiday anyway. So I think that there's something that's happening within tenants of office space.
I'm not sure you're right on that point, but it doesn't really matter for you guys if people go back to work downtown. It might be a negative.
It could be a negative, but I think that it has to do with employees changing their mindset, because the mindset has been, I'm working from home, I really enjoy it, to, I think right now there's certain employees that want to come back to work at the office because the vacation is over. But time will tell. I don't know if my prediction is.
I think you're wrong. I think you're.
But I think it. Yeah, I agree. You're allowed.
I'm allowed to disagree with you.
You're allowed.
I think unless you get a significant recession, you're not going to be able to. I think corporate's going to have to change their perspective rather than vice versa. But if you do get a significant recession, people lose their jobs, they're going to take whatever job they can get, is my view. I want to talk a bit about the yield and the debt. Let's start with the debt. So you guys are, what's the leverage like right now?
We're at 59% total. So we were at 162, now we're down. And if you go to the chart, and that could be interesting to show this chart on page 29.
Okay.
Basically shows the evolution of our portfolio. And in 2011, our leverage was a little bit short of 80%, and now our total leverage is below 60%. On the mortgage front, it's 54%. So we have two series of debentures that come to maturity, one next year and the other one the year after, that are not redeemable before the month of November of this year.
Your 7%ers are still over par. Yeah. They're over par.
They're over par. And then you have another issue like a 9%.
The other one's
6.9.
6.9, and that one's around par, I think. One's higher and one's about par.
Okay, so what's the plan when those mature?
The plan is not to reissue debentures.
Okay.
In order to keep our debt lower.
Okay.
Going from 59 to just pure debt on properties, which would be around 52-54%.
And you're going to retire that debt with cash flow?
Either with cash flow or selling certain properties or getting into development opportunities and getting proceeds from development that would help us pay down the debentures.
Okay.
Just to clarify one thing, the one in 2025, so the one that is maturing in 2 years, that one has a conversion price of $364. So that one we saw conversions all the way to the end of last year, and then the price went down. So it's a pause. We expect this to continue to convert as well.
It's a convertible.
Convertible debt, yeah, above 360.
Both are,
Yeah.
but the other one, the one that's maturing next year, is not in the money.
Yeah, it's at 5 something. Yeah.
Okay, so the plan is then, where does that situate them with respect to most REITs in this space, Claude? Is that there, or do you guys know?
We're at par.
Roughly same
When we
leverage?
get rid of our debentures, we're going to be at par with everybody.
Roughly the same leverage.
Yeah.
What does the debt cost you on an average basis right now?
Slightly above 4%.
And what does that maturity ladder look like?
If you flip on the next page, the bottom page, you see maturities. This year we have 68 million, which is about 10% of our mortgage book.
Yeah, 20% next year, 10% the year after, etc.
So I think it's well spread. One thing we did take advantage during 2020, 2021, all the way 2022 to refinance some of the debt. So we almost refinanced 50% of our debt book.
Oh, what, like 2-3%?
Yeah.
So what's happening now? So if you have your 5-year from 2018 and you're renewing this summer, what's the difference in price that you're renewing at?
Yeah, so today we'll refinance in the high 5 probably, and then that we have to refinance coming to maturity that was underwritten 5 years ago in the mid 4.
Okay,
It's 100 points or 150 points, thereabouts.
1.5% higher. What about the ones that you did when rates were really low there for 2 years? How much of your portfolio is in that?
50%.
Yeah, about 50%. We were able to lock some of the debt at 3.1, 3.2% for 10 years.
For 10 years?
Yeah.
In some cases. So
We have let's call it a shopping center in Lévis, which is a suburb of Quebec City, that we booked on a 10-year basis. And within this environment, it was a low interest rate deal that we concluded, so we went long. So at that time, as he mentioned, we went 5 years or 10 years, depending on the cost of money at that time. And so there is 50% of our portfolio that's at very advantageous rates.
Are there any plan to do more kind of market debt? No, that's done.
We don't want to do that.
No, okay. It's too expensive.
Not that it's too expensive. We want to reduce the debt burden.
Do you think you need to do that?
We want to be around 50%, 52%. It's a more comfortable area. Debentures, I think Claude will say, they're easy to sell, but they stick around for 5 years. So you're stuck with the problem for 5 years. So if there's any kind of movement within the economy or whatever, you're always dinged by that. So we just want to get out. And they sell very well. If we were to put them on the market, they sell very well in a good market. Right now, we wouldn't go on the market with a series of debentures because we know that it's not the right time to do.
I want to get to the yield and the payout ratio and the safety of the yield. Current yield is 30 cents. You guys have been paying...
What we're paying out is 30 cents. The distribution is 30 cents. We're generating 45 cents.
Okay.
So we're way above water.
If I look at your historical payout ratio, it's gone down consecutively over 4 consecutive years, 2020, 2021, 2022. It's probably at the lowest it's ever been right now.
It's the lowest it's ever been.
Okay, the payout ratio obviously is the percentage of cash flow that's paid out via dividend or distribution. You're at 73%. What is that forecast? Higher costs with debt, higher rental income, is that forecasted to go up or down in the future? Your pro forma.
I don't want to steal the answer, but obviously the cost of debt is going to impact us.
Yeah.
But it's not going to impact us where 73% goes to 85%.
Okay.
It's just going to be a slight increase because the cost of debt is 1 cent to 2 cents. So if we're generating 45 cents, we're going to sit at 43, 44 cents. So it's not a huge impact, but it's not going to be 73 going forward until the interest rates go down. And as we talked about, there's 68 million of debt that's coming to maturity this year that is in process of being renewed because we have great relationships with our bankers and they are renewing because I know that it's for certain individuals it's difficult to get debt. We don't have the difficulty of getting debt on our property. So they're being renewed, slightly higher interest rates, and because it's only 68 million, it's not having a great impact. Now, next year, we're seeing 109 million coming to maturity, excluding the debentures. And all the forecasts that we're looking at are predicting lessening of the interest rates. So hopefully our timing is great regarding having a lot less mortgages coming to maturity this year versus next year.
Michel, on that topic of debt and extra cost, some people are claiming that whatever extra cost you have by refinancing on 1 or 2% higher is offset a year or two down the road by increased rents. Do you agree with that statement?
Absolutely. We talked about the fact that we were still able to increase rents in the office segment or in the retail
But by
segment.
the same amount?
It's not the same amount.
Okay.
We all know that to try to time everything doesn't work, and that's how you get gray hairs. It's just, it's just if you're trying to time everything, like timing a disposition versus an acquisition, it's never perfect. It never works. So hopefully everything irons out over time. Time is obviously the best friend of real estate. And so it's impossible to time. So I wouldn't be able to tell you, oh yeah, we were able to lift rents.
His question was, you were saying earlier that rents are up 12%.
Yes.
That's the numerator and the denominator in your formula.
But it's not 12% of $120 million of rents generated. It's 12% of the rents that came to renewal during the quarter.
But my question was, they're renewals, so you're getting an extra 12% of whatever's renewing. Does it offset, like your mortgages don't all come at the same time either.
Exactly.
So your renewals, which is maybe 5% of your portfolio or 10, I was asking, is the offset pretty close between a small portion that you're renewing at a higher rate?
It's close. The other thing on the revenue side, we're able to increase rent. Then on the cost side, a lot of the costs are passed to the tenants as well. So we're not that impacted by the inflation on costs. And then as we buy new industrial properties, as we shift to that, most of them are triple net leases where the tenant is responsible for the cost. So that's another as well mechanism where we can say we hedge operationally that inflation on the cost side.
But are you saying that your offices are not triple net?
The leases with the government, our largest tenant is the Government of Canada, and the leases with the Government of Canada are gross with yearly adjustments. So it's not gross, it's not an apartment rent. So it's not gross. So you can pass on increases in real estate taxes, you can pass on certain increases in operating expenses, certain expenses linked to utilities, but not all. And that's the way so the Government of Canada, Government of Quebec, same type of leases. And so those are basically an aberration within our portfolio, yes, but we like leases with the governments because it creates stability in the portfolio as far as revenues are concerned. But there's a dark side to that, is that you're not recuperating 100% of your costs.
So when you started, you said the 45 cents of revenue, or whatever you want to call it, funds from operation, that number is going to be higher next year, I imagine? Do you think the number is going to be higher next year?
With the increase, with the acquisitions that we did, one other important thing as we look at underwriting a new transaction, as when we do an acquisition, we make sure that this acquisition, as opposed to some other REITs, but we always plan on a conservative way. So we saw the impact of the large acquisition. We did almost 300 million of acquisitions since 2021, and those were accretive.
Yeah,
and we see the impact on the FFO growth.
Yeah.
And that's what...
Is there a chart here on the AFFO?
That one, but it's on a quarterly basis.
Okay, so yeah,
You can multiply.
is this going to be up next year if you come back here in a year from today? Is
Well,
this
we're
number going to
expecting-
be higher?
that's what-
Yeah, and obviously you just said the cost is going to be higher, 1 to 2, maybe 3 cents because of the increase in financing costs. So in theory, your percentage, if they both go up by 2 cents, your percentage kind of goes up
A little bit.
But if you get a little bit of a bump in your revenue, like my dad's question, a little bit more than 2 cents, then you could get a payout ratio that goes down in theory.
Good.
Yeah, but it might not be. But regardless, whether it's 72% or 3% or 4% or 5%, it's the best it's ever been for BTB.
It's never been better.
Managing below 80%, I think it's a good target for us to be comfortable with the distribution and continuing investing in the organization.
Well, there was a time 10, 15 years ago when no REITs were under 80%.
The heyday.
I remember when if somebody at 80 it was unreal. A lot of them were right at par. But anyways, the times have changed now. Just about everybody now. Otherwise, your stock goes in belly box if you're not at 80 now.
There's a certain maturity also to the sector, right?
Yeah.
I want to get to the stock price in a sec, but just quickly on the occupancy rate. You guys have always had a relatively low occupancy rate relative to other REITs, I think. It's the nature of the space, I imagine. Is anything else happening there?
When we're looking at our retail, we're always between 96% and 98% occupancy. In the industrial, always around, let's say, 94, 96%. Now we're 100%. And in the office, that's where the number hurts because, first of all, if you own an office building and you have 100% occupancy, you're in trouble. Because if a tenant wants to expand, you can't expand the tenant. If you can't expand the tenant, it means at the end of their lease, they're leaving. So I would say that 100% in the office segment is probably around 94, 95%, which is the comparable.
You guys aren't there. You guys would be in the high 80s in your office?
We're 90%.
Okay.
90%. And Montreal, we're much higher than that. Ottawa, we're almost 100%. The city that makes us bleed a little bit on that front is Quebec City, where last year there was an adjustment in our tenants, and as a result of this, we went down to 86% in Quebec City, and now we're on the uptrend again in Quebec City.
Okay, so this says 93% occupancy. So if you're 90% in office and that's half your portfolio, you'd be 96% in the rest of the portfolio, something like that.
Don't forget we're 100% in the industrial.
Right, you're lower than in some of those, obviously. You'd be high 80s probably and low mid 90s in your retail.
Retail, I don't remember if we're 96 or 94%, but it's hovering around 94, and now it's going to correct itself to 96 or 98%.
What number do you want to target on this? If everything goes well, what should this
My big target is north of 94%.
94.5.
That doesn't, like you say this, and it's not like great because it's not 100%, but I think that what's achievable is 94%.
Okay. Any questions on that, Claude? Okay, I want to ask you about the stock. Is the market that stupid? If you guys are convinced that your IFRS value and you have sales that have demonstrated that your model works and the numbers are accurate and your cap rates are accurate and you're not fudging the numbers and you have a third-party appraisal and this is a real portfolio and people can go and tour the buildings and look at them and see your rent rolls, why is the stock at $3?
I think it's because, again, it's throwing away the baby with the bathwater. It's just people are saying real estate's no good, office is no good, therefore, let's forget about it. And as people are going to buy back the stock or buy again the stock, I think that the story itself is so clear. And as we're migrating towards more and more industrial and less office, I think things are going to correct themselves.
One factor that nobody ever brings up anymore because I don't think it exists, but going back 30, 40 years, there used to be a Quebec discount because of separatism and the fear that, and then businesses having a hard time doing business in Quebec because of the French requirements and all that. Is that a factor? Is that a discount or not anymore?
Everybody is telling me not anymore, but I think that there is one.
But is it the independence or is it to do business in French?
I think that from the rest of Canada, there's a Quebec discount, that they impose a Quebec discount, whether you like it or not, whether we like it or not. I think that there is one. Not as much as it were before. I think that it's really shrank. I think that basically when you talk about separatisms and language, I think separatism is something that's basically out the window. The numbers, there was a recent poll, and the numbers are like very small as far as people that still believe in it. And they reported back on Quebec City, which should be like a great area in order to foster separatism.
The hub of separatism.
Maybe, but that's another world altogether. And they are like less than 20%. And the number has never been this low. And overall, the number has never been this low. On the language front, it is what it is. People, they're imposing the French. If you're in Quebec City, if you're in Rimouski, who cares, right? Everybody speaks French. So where it's hurting a little bit is in the city of Montreal. Because in Montreal, it's an international city. So how can you impose your language? I find it very hard. But as far as doing business, there's no limits. You get all the international companies that have office space, that operate from the city of Montreal and so on. And what they want is skilled workers. They want the brains. They want to hire brains. So there is good inventory of brains in the city of Montreal, having 5 universities that are based there and so on. It's a very fertile ground for recruitment. So that's really in the past. But as far as trading, if you take, 2 similar REITs, next one's based, headquartered in downtown Toronto and the other one in Montreal, I think that the one in Toronto is going to trade a little bit higher than the one in Montreal.
Yeah, it's a reality, I think, that the big funds international, there's a box there and they click political risk or whatever, and there's a deduction of points there when it comes to yours versus somebody else.
Yeah.
If you're a long-term investor, it's great because you're getting the excess return for a risk that may not be there, but it's perceived to be there.
You're buying the stock at a discount, which increases your yield, which gives you the excess return.
Exactly.
Right, so let's say the real risk for B2B, let's say, should yield 8%. Okay, everything being equal, and it's yielding 9%. So you're getting now 1% extra because of a perceived risk of being in Quebec, if it doesn't exist.
Yeah, and that real risk might be worth 0.1% or 0.2%. But I think it's pretty much non-existent. Honestly.
No, I agree. Like my opinion.
It's not 1984.
That's right. The big threat was separation.
Rob is right. Yeah, and that's out the window, and maybe the news should come all the way to Winnipeg that's saying that the risk is out the window. But all this to say is that we own properties in Quebec City proper, so in the primary markets of Canada. So Quebec City proper, Montreal proper, Ottawa proper, Saskatoon proper, and Edmonton proper. So all of a sudden, we can't be perceived as being concentrated in the province of Quebec anymore because we have initiated a geographical diversification, and it's working out for us. And we're still buying properties in Edmonton, still looking at that market. It's a great market for us, the same as Saskatoon. And because we can buy, as Mathieu mentioned, we can't buy an industrial property in Toronto. Like Mississauga is priced out of the market for us. Same thing with anything that would be around the city of Toronto. So we can't look there. So because we want to make sure that we don't change all the nice numbers that we're putting forward in front of you this morning, it's just like we have to make sure that we're accretive when we buy. So if our cost of capital is higher, then it means that we have to push the cap rate when we acquire as well.
Well, Michel, one of the reasons I was attracted to you back in 15, 20 years ago was that everybody as portfolio managers, we have real estate diversified across the world, the U.S., Canada, but nobody was in Quebec, right, because of the perceived risk. So to balance our portfolios, if we were 100% everywhere else in the world, nothing Quebec, it was a nice sleeve to have of a Quebec exposure for, to me at the time, was an extra 2% return for a risk that was perceived and I didn't think it was reality. But now you're going to expand everywhere, so you might be like all the others. Anyway.
Have you thought about buying some shares?
We put an NCIB in place.
How big is the NCIB? Non-course issue bid?
Yeah. It's
No.
30 million.
30 million.
30 million?
Yeah.
Anywhere you would buy over 6 months or whatever?
We have to file notices and so on. So it's when we're selling properties, that would be the right moment for us to get the capital and use the NCIB.
If your IFRS is 550 and you're buying at 310, that's a pretty good shareholder return if you truly believe that, right? Mm-hmm. That's probably better than going and buying a property.
We did the calculation, and when our stock, let's say, was at $4, it's better to buy in Saskatoon.
Yeah.
But at $3.14, I'm convinced it's better to buy back the shares.
Yeah.
So it is a calculation. It's a simple math.
Yeah, it's a spreadsheet.
So when we're selling properties, then that if we're taking the cash and buying back the shares, it's a good thing for us because we're losing NOI, what you talked about earlier. So we're losing NOI, but we have to buy back the shares in order to make sure that it doesn't upset the famous 73%.
Could there be a situation where NOI goes down and you need to cut that dividend?
Not at 73%.
That would have to hit what number for you guys to consider that?
100%.
Okay.
So right now we have an ample buffer in place.
Would you consider increasing it if that number went to 65 or something?
I would have to be convinced that by increasing it like substantially would drive the price of our stock north. That would be a good thing.
Because otherwise you're better to use that, you think you're better to use that capital to acquire or to buy more shares?
To upkeep our buildings.
But assuming you already have to do that.
Yeah.
So I'm talking excess cash.
Yeah.
Because that's the only place you could spend excess cash would be either give it back to the shareholders, acquire properties in Saskatoon and Edmonton, or buy more of your shares.
Yep.
Those are your choices with the excess cash.
Absolutely.
That 27% of every dollar that's not distributed, you have a choice to make.
Absolutely.
As CEO. And you're choosing every day what to do with that cash. Retire debt, pay more dividends, buy more properties, or buy shares, right?
Absolutely.
I do want to respect your time. We're very considerate and appreciative of you guys making your way out to Portage in Maine, Winnipeg, Manitoba, Canada, where you're never going to buy real estate, probably.
I don't know why you say that. In Maine, no. But
St. Vital,
yeah, exactly.
Transcona.
Yeah, industrial properties. Everybody needs industrial properties, right?
Yeah.
The people are distributing in Winnipeg as well as in Saskatoon, as well as in Edmonton and Toronto.
I'm actually really bullish on real estate values in Winnipeg for a whole bunch of reasons. But I know you guys don't focus on the debt. We are like right at Portage in Maine here, so
I know.
This is outside of your wheelhouse. I do want to thank you guys. Anything else that you'd like to add that we missed? I know you guys have a phenomenal story here. I do want to keep it relatively tight here. Anything else that you'd like to add?
We talked about earlier about development projects. We have on our retail sites, we have excess land. So we are trying to monetize the excess land. So we came to an agreement on the island of Montreal for one of our sites with a residential developer, and he's paying us $30 million, a little bit more than $30 million, to buy the air rights on our shopping center in order to put up residential towers. So this $30 million is it's 30 cents per unit. So IFRS value, your calculation would go north to $5.74, but it's not priced in our IFRS value. We have another development, as I mentioned, in Lévis, Quebec, which is a suburb of Quebec City, where a large retailer wants us to put up a building for them, a retail building with 43,000 square feet. And so we're just waiting for approval from the city in order to change the zoning.
Rezoned, take a parcel out, sell it. It's completely accretive. It doesn't show up anywhere. It's just new revenue. The only potential cost would be
the development cost.
Yeah, but you're bearing some of that.
But not definitely not all.
So if it's a $30 million payout, you're bearing $3 million or $5 million or $10 million of cost, and the other 30 is coming in.
And that's how, if we're trying to time everything, this development would basically reimburse a good chunk of the ventures that are coming to maturity.
That one project is 10% of the market cap today.
Of the company.
Yeah. And then we have another project that's located in Ottawa, where when we bought an office building, we also bought excess land. And the excess land is being rezoned by the city right now. It's situated right in front of an LRT station, and that's the reason why it's being rezoned. And as a result of it, the piece of land that was zoned exclusively for office now could be used for residential. And that's another $9, $10, $11 million that is not on our balance sheet. What's it
going per acre there? What would an acre of residential zoned multifamily in that place in Ottawa?
In this case, it is less than an acre, and we're talking about $8 million. Okay. It's always linked to, we're not in the boondocks. We're right on the Trans-Canada Highway, right where the LRT station is being built. We have that piece of land. Ottawa, and I'm sure you've read the papers, Ontario is basically saying, we don't want urban sprawling anymore, we want to concentrate and we want to go high.
Yeah.
So that's what the Prime Minister Ford said. So that's where we are. And so automatically the city had decided to rezone, and it's going to be a higher proposal. So those are languishing things that are in the portfolio that they're not yet concrete, but they're coming to maturity. We're working hard in order to redevelop and put forward new ideas in order to create value for our unit holders.
Fantastic. Michel Leonard, President CEO BTB REIT, Mathieu Bolte, CFO BTB REIT, my dad, Claude, and myself, Rob. We thank you for tuning in, guys. Make sure to like, subscribe, get us your comments below. What do you think about real estate? Is real estate in Quebec? Is that something you want in your portfolio? Would you do it through a publicly traded company like BTB? Let us know. Thanks for tuning in, guys. We'll see you in the next video.
Thank you.